Welcome back to Investing Talk Podcast.
Today we're looking at innovative eyewear.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. With innovative eyewear, you've got a really compelling but volatile story.
Right.
This is a classic example of a tech disruptor. They're prioritizing scale over profit right now. So you see this incredible top-line growth, but it's paired with some really heavy operational losses.
That immediately puts us on alert, right? I mean, we love high potential, but we need to see if that strategy is actually paying off. So tell us about that growth.
Absolutely. The financial picture, it really starts with that revenue acceleration. As of March 2025, the company reported a massive 42% increase in revenue year over year.
Okay, 42% is strong.
It is. But what's really spectacular is what happened later the year. If you look at August 2025, that year-over-year growth almost doubled. It hit a staggering 88%.
88% growth. That's explosive.
Right.
And that took their revenue for the period up to, what, around $579,000?
Exactly. $579,230.
So where did that fuel come from? You don't just jump that fast without something specific hitting the market.
No, you don't. It was really driven by two product lines. First, their Lucid Armor line, those are their safety glasses. And second, the Reebok Powered by Lucid collection.
Ah, the Reebok collection. That pushed them right into that active lifestyle space.
It did. And it signals they're successfully expanding beyond just, the core tech fans into these really high-demand verticals like professional safety and athletic wear.
Okay, so that's the impressive side of the coin. Now we have to flip it over. The part where high-growth hardware companies always seem to struggle. Profitability.
Precisely. And this is the main point of concern, but it does need some context. Despite that amazing revenue growth, the margins are under extreme pressure. Gross margin is currently negative 3.8%.
Okay, negative gross margin is already a red flag.
It is. And critically, the net profit margin is deeply negative. We're talking negative 514.5%.
Wait, say that again? A negative 500% margin. That sounds catastrophic. How is the market even processing that?
It sounds alarming, and it is extreme, but for a company in this phase, it's not totally unexpected. What that number tells us is that for every single dollar of revenue they bring in, they're spending about 5 times that on operations, R&D, marketing, all of it.
So the loss from continuous operations was over $2 million in the last period.
It was. So they're effectively subsidizing every sale to just grab market share and scale up. They're banking on that Reebok name and pushing the safety line hard. But yeah, they are burning serious cash to do it.
So the strategy is to capture the market now and hope economies of scale kick in later to fix those margins.
That's the playbook. The company points to things like higher tariffs and importation costs as a specific problem, and they say they're working on it by diversifying their logistics. But the execution risk is high.
Okay, losing $2 million a quarter to get almost 90% growth. That brings us to the most critical question. How long can they keep that up? We need to look at their safety net, the balance sheet.
And that's exactly where the story shifts, actually, in a pretty dramatic way. Despite those huge losses, the balance sheet offers a ton of stability. At the end of the last quarter, Innovative Eyewear had $7.62 million in cash.
$7.6 million in cash.
And, this is key, virtually no long-term debt.
Okay, so with a burn rate around $2 million a quarter, that's a multi-quarter runway right there. That's a decent cushion.
It certainly is, and that flexibility is why their liquidity numbers are just off the charts. We usually look for a current ratio to be above 2 for a healthy company. Innovative Eyewear is sitting at a staggering 18.7.
18.7. That's not just comfortable. That's like having a fortress. For every dollar they owe short-term, they have almost $19 in liquid assets to cover it.
The quick ratio is just as good at 14.8. These numbers are so far beyond industry norms that, the near-term financial risk of them going under is basically zero. They have the runway.
But where did that cash come from? We know it's not from operations, so that means capital raises, right?
That's the necessary asterisk here. Their cash flow is negative, which is normal for this kind of company, but they've been relying on warrant issuances to pad that cash position.
Which means future dilution is a risk.
The risk is dilution, exactly. When those warrants get exercised, new shares get created, and it dilutes the ownership for current shareholders. It's a trade-off. Cash now for potential share dilution later. For now, though, that cash position is phenomenal.
Okay, so we have high growth, great liquidity, but terrible margins. Now we need the why. What's their competitive moat? What stops a bigger player from just crushing them?
It all comes down to niche specialization. They are not trying to compete with the big tech giants in the general consumer space. They are specializing in smart eyewear that meets critical safety standards.
The certified safety eyewear niche.
Exactly. The key differentiator is their Armor Slim model has ANSI certification. That is a massive regulatory hurdle to clear. It means the glasses are certified for industrial use, where safety is absolutely non-negotiable.
So this creates a moat that keeps the general consumer tech companies out.
It does. This isn't about using ChatGPT to, walk your dog. This is about a worker on a construction site using a voice command to pull up a blueprint without taking off their safety gear. It's an industrial tool, not just a gadget.
That makes perfect sense. And they're building on that with software too, right?
Right. They're pushing the innovation hard. They've got full AI integration, specifically ChatGPT compatibility, and custom Siri commands for a hands-free walkie feature. So it's about real hands-free productivity.
And is that strategy getting them traction? Are they actually getting into the right channels?
The traction is very strong. They just secured about 40 new optical industry accounts at Vision Expo West.
Right.
And even bigger, they landed a partnership with iRecommend in Canada.
And that puts them in how many stores?
Over 600 independent optometry stores. This is huge for them. It moves them out of just selling online into established optical retail. It really validates the whole strategy.
Okay, so a multi-layered advantage. Regulatory, innovation, and now distribution. Let's switch gears to the technicals. What is the stock itself telling us?
The market is definitely paying attention. As of November 12th, the stock closed at $1.77, which was up over 20% in just one day.
A 20% pop. That shows some serious momentum.
It does. And it wasn't a one-off. The stock has been up in 7 of the last 10 trading days, so there's a narrative building here.
So what's the expected range for the next few months?
The forecast is pretty wide, which reflects that high-risk, high-reward nature. It's sitting between about $1.63 on the low end and up to $3.36 on the high end.
So for a trader looking to get in on a breakout, what are the key levels they need to be watching?
The big resistance area is between $2.60 and $2.33. A sustained close above that $2.16 level, especially on high volume, would be a technical buy signal. That would suggest the momentum is real.
And support.
Support is right around $2.08 down to $2.05.
And the broader technical bias, are we in an uptrend yet?
Not quite. The longer-term moving averages are still negative, reflecting the past year. But, and this is important, the extremely high volatility and recent volume suggests active accumulation. It looks like momentum traders are building positions, betting on this emerging bullish setup.
Speaking of news, what are the upcoming catalysts? What could move the stock in the next few months?
The single most important date is right around the corner. The Q3 2025 earnings release, expected around November 15th.
And that report is all about the margins, right? Not just the revenue.
Exactly. We expect the revenue to be strong. The real test is, can they show even the slightest improvement in cost control? Can they narrow that negative margin? That's the litmus test.
And beyond that, we've got Q4 earnings in February. Any other catalysts?
Yeah, a few. They're planning more AI-integrated product launches for late 2025, probably for the holidays. Then you'll have the holiday sales report around December 15th.
And then the institutional holdings data in January.
Right. That's a big one. It'll show us if the big funds are starting to buy in, which would be a huge vote of confidence.
And that all feeds into the speculative buzz, right? What are the rumors floating around?
Well, nothing's confirmed, of course, but the persistent market chatter is about a potential acquisition.
Because they've done the hard work of getting that certification.
Exactly. A bigger tech or eyewear company could see them as a perfect bolt-on acquisition to get that IP and market entry. There's also talk of tech licensing deals or another major sportswear collaboration like the Reebok one.
Enticing stuff, but we have to balance that with the risks. What's the bear case here?
The primary risk is simple. Can they ever become profitable? The execution risk on cost control is huge. And then there's the dilution risk we talked about. Relying on warrants for cash is a constant threat to the share price.
And finally, competition.
And competition. The big players are watching. If they see this niche is profitable, they could decide to move in, and they have much deeper pockets.
So let's pull this all together. Explosive growth, rock-solid balance sheet, unique certified tech, but paired with deep losses and real execution risk.
It's the definition of a high-risk, high-reward play. Our analysis points to an overall bullish thesis, mainly because of that accelerating revenue, the cash runway they have, and some very compelling near-term catalysts.
And is this a short-term trade or a long-term hold?
It looks interesting for both, actually. The upcoming news flow creates opportunities for short-term traders. But for a long-term investor, the potential of them scaling successfully or, frankly, getting acquired makes it a strong story. And that's the critical element to watch. For you, the listener, the immediate focus should be on that upcoming earnings report around November 15th. That report won't just confirm if revenue growth is continuing, but it will crucially signal if the company can effectively manage margin pressure and begin the necessary pivot from pure scaling to achieving even rudimentary cost control. That transition will define the next phase of the investment story.